So what is the Fed? In 1908, Congress created the National Monetary Commission to propose solutions to the nation's banking problems. In 1913, Congress passed the Federal Reserve Act on the recommendation of the NMC. The act resulted in the Federal Reserve System, often known as the Fed. The Federal Reserve System was composed of a group of 12 independent regional banks in which the banks could lend to other banks during times of need. However, the system did not work well during the Great Depression because the 12 regional banks acted independently. Through the Banking Act of 1935, Congress adjusted the Federal Reserve structure so the system can respond more effectively to future crises. These reforms created the current Federal Reserve System. The new Fed is more centralized, so the regional banks can act consistently with each other while still representing their own district's banking concerns. The Fed also includes the Federal Open Market Committee, also known as the FOMC. This is the policy-making branch of the Federal Reserve. The voting members of the FOMC are the 7 members of the Board of Governors. The FOMC makes the important decisions on interest rates and other monetary policies. This is the reason why they get most of the attention in the media. In addition, all national banks and some state-chartered banks are part of the Federal Reserve System. These banks are referred to as member banks.
So what is monetary policy? Well, first off, the Federal Reserve System is overseen by 7 members of the Board of Governors. A chair is then appointed by the President to act as the main spokesperson for monetary policy for the entire country. Monetary policy involves the actions that the Federal Reserve System takes to influence the level of the real GDP and the rate of inflation in the economy. Monetary policy is also used to tame business cycles because they have unpredictable links. Thus, this makes it difficult to determine the right time to intervene in the economy. How monetary policy works is that it alters the supply of money, which in turn affects interest rates. Such effects in the economy can follow easy money policy or tight money policy. Easy money policy occurs when the economy increases the money supply due to experiencing a contraction or declining income. As a result, this encourages investment spending. Tight money supply occurs when the economy reduces the money supply due to experiencing a rapid expansion that can cause high inflation. Thus, this raises interest rates and decreases investment spending. It is also important to have good timing to lower the chances of inflation in case of any recessions. However, there are also problems in the timing of policies in the economy known as policy lags. Inside lag is a delay in implementing monetary policy, and outside lag is the time it takes for monetary policy to have an effect.
The Federal Reserve can use 3 tools to achieve its monetary policy goals. These tools include the discount rate, reserve requirements, and open market operations. The discount rate is the minimum interest rate set by the Federal Reserve for lending to other banks. The reserve requirement, or the cash reserve ratio, sets the minimum amounts of reserves that must be held by a commercial bank. Open market operations are used to buy and sell government securities to change the supply of money. Examples of government securities include treasury bills, treasury bonds, and treasury notes. All 3 monetary policy tools affect the amount of funds in the banking system. However, the most important monetary policy tool is open market operations. Expansionary monetary policy increases the amount of money in circulation, using the 3 monetary policy tools to expand the economy. The 3 monetary policy tools can be used in these ways. By lowering the discount rate, it makes it easier for banks to borrow from the Fed, placing more money in the economy. By lowering the required reserve ratio, it allows banks to make more loans, creating more money in the economy. The Fed also buys government securities such as government bonds, which increases the money supply in the market.
The Federal Reserve can also use these 3 tools as contractionary monetary policy tools. Contractionary monetary policy tools are used to reduce the amount of money in circulation. This raises interest rates, which slow down the rate of borrowing and economic activity. By increasing the discount rate, it makes it harder for banks to borrow directly from the central bank since the interest rates have increased. As a result, the money in the economy decreases. By raising reserve requirements, the amount of reserves commercial banks are required to hold rises. This does not allow for as many loans and decreases the amount of money in circulation. By selling U.S. Treasury securities in the open market, federal fund rates increase. This would discourage banks from borrowing money. Since banks have less money, there is less money in circulation available for the economy.